How is the yield curve calculated? Have you ever wondered how the yield curve is created and what it means for options trading? Understanding the yield curve can give you a clearer picture of market trends and help you make better trading decisions. Let's break it down step by step. The yield curve is a visual representation showing the relationship between bond yields and their maturities. To calculate it, we start with a set of bonds that have the same credit quality but different lengths of time until they mature. The yield for each bond is determined at a specific point in time. First, let's talk about yield calculation. The yield on a bond is the annualized interest rate that an investor can expect to earn by holding the bond until it matures. This yield is calculated based on the bond's price and its coupon payments. Next, we use a discount factor function. This function represents the present value of receiving 1 unit of currency at a future date. It helps us calculate yields for various maturities. Zero coupon bonds are particularly useful in this process. These bonds do not make periodic interest payments, and their prices reflected the yield for their respective maturities directly. Now, let's go through the calculation process. It begins with gathering market data on bond prices or yields. This data can come from government bond markets or money markets. Since not all maturities have directly observable yields, we use interpolation methods to estimate yields for intermediate maturities. Common methods include linear interpolation and cubic splines, which are more complex techniques. Once we have our collected and interpolated yields, we fit a curve that best represents the yield curve. This involves minimizing the errors between the observed and fitted yields. Some institutions, like the United States Treasury, use a monotone convex method to ensure the yield curve is smooth and does not show negative forward rates. The yield curve has practical applications in stock trading and options. It serves as a key economic indicator. A normal upward sloping curve suggests economic growth, while an inverted curve may signal a recession. This information is essential for traders when making decisions about stocks and options. Moreover, the yield curve helps predict future interest rates, which can influence stock prices and options trading strategies. For example, if long-term yields are rising, it might indicate a stronger economy, which could benefit stocks. Finally, understanding the yield curve can assist in managing risks in options trading. Changes in the yield curve can affect the pricing of options, especially those with longer maturities. By grasping how the yield curve is calculated, traders can make more informed decisions about market trends and potential risks, ultimately enhancing their trading strategies.